This is our week number 6 introduction video for Accounting 202. This is Professor Hassey. Happy Sunday. This is an introduction to our classes March 8th and 10th of the coming week, leading up to our spring break after this week. This is exam week. We have exam number 1 posted on Wednesday from chapters 1 through 5, and it'll be due Sunday, March 14th. We're going to finish up our discussion on Monday with break-even point and variable and fixed cost. We're going to be looking at problems 1, 2, and 3A from the 5th chapter, which would be a good review for that. We'll also be looking at this week an outline of the exam, what to be prepared for on Wednesday. That's posted in your Blackboard. And before we get into chapter 5, and I have a little video in that regard, I want to just go over a couple of final points in regards to quiz number 1, because you'll see those problems again in your examination this week. All the grades have been posted, the solutions, but I want to go over a couple of key points that some of us need to look at as review for examination number 1. First of all, in chapter 2, the question number 2, the allocation of a predetermined overhead rate and then determining the over or under applied nature of that overhead. Remember, there's 3 types of costs in manufacturing: labor, materials, and overhead. And overhead can be applied at a predetermined rate before you actually know the actual overhead costs. So in this problem for Department A, the overhead rate was based on direct labor cost. Whatever relationship the overhead that is being planned, in this case for Department A, the planned overhead is the planned overhead for allocation is going to be determined based on labor hours, so or labor costs. So notice we have $1.5 million of planned labor costs in Department A with a planned manufacturing overhead of $2.1 million. That means that overhead is 140% of direct labor costs. That's the allocation rate. For Department B, it's based on machine hours. We have 400,000 planned machine hours with an overhead of $1.4 million planned. That's a $3.50 per machine hour overhead rate for Department B. So in Department A, with 140% of direct labor costs being allocated, if our labor cost was $100,000, 140% of that is our overhead rate of 140,000. In Department B, if we're going to use 34,000 machine hours at our rate of $3.50, that means our overhead will be 119,000. Thus, we get a total manufacturing costs in A and B of 435 and 357. If we take a look at what we applied and what we planned, we had 140,000 applied overhead, 119, that's 259. We originally planned 130 and 135, the actual. That means that we have an under applied of $6,000. Make sure we understand that definition of under and over applied for examination number 1. In question 3, some of us had a little bit of difficulty determining the equivalent units. Remember, the equivalent units is the relationship of how much are complete. And they tell us that in this problem that we have work in process of 5,500 units on June 30th. How did we get that? We had 2,000 beginning. We had 8,000 units started. We had 4,500 units transferred out as materials completed. Thus, we have 5,500 left. If they tell us that 60% were complete of this ending inventory of 5,500 units, that means an equivalent units of 3,300 units in work in process. So our conversion costs will be the combination of labor and overhead right here. We take that into account and we determine our conversion cost per unit of $1.25. We take our ending inventory value of work in process of 3,300 units times the $1.25, and we get $4,125 as our conversion cost based on that equivalent unit per unit number. Okay, so that's important to know for examination number one, how to determine the difference between total units and what is equivalent. It's based on how many are complete at the time of the ending inventory. And then finally, in the last question, but most of us got this one and did a very good job on it, on applying the assigned cost based on the problem given in the example. And first of all, the original problem, if we would take a look at the sample, a single overhead rate, if we were determining based on labor hours, it was $24. We allocate that, we end up with $120,000 in total costs of chairs and dining tables. That goes forward to determining if we do want to base it on machine setups or inspections. We end up with 37,000 for dining chairs, 83,000, or again, $120,000. But notice it's split, it's different in regards to dining chairs and tables. The cost is a little bit different, but it ends up being the same amount. So I was looking for that difference by using the activity base versus the predetermined or single overhead rate. So those are just a couple of key points from the quiz that you need to make sure you have, because they'll be on the examination one of this coming week. Now I want to just look at a short video, kind of a goofy video, but it serves its purpose, explaining the break-even point in relationship to this farmer. So let's take a look at this video.
This is Farmer Joe. He grows apples. And this is investment banker John Parker from Goldman Sachs.
Good day to you, sir.
Howdy, partner.
Farmer Joe, have you ever heard of the break-even point?
Well, I don't care about a fancy thing called the break-even point. All I want to know is how many apples I have to sell to make money with my business.
Well, that's exactly what the break-even point is for, Farmer Joe. So, are you interested in it?
Yeah, for sure. Tell me more about it.
Alright then. So, first of all, we need to know how much do you charge for an apple?
I charge $1 for an apple.
Do you eventually know what the production costs of one apple are?
Well, a fancy guy like you used to do that math for me. He told me that I spend 50 cents an apple for diesel, pesticides, and labor. But I don't know if I would trust the Harvard guy.
Yeah, whatever. So, these are your variable costs per apple. Variable means that if you don't crop any apples, you would have no variable costs. Is that clear to you?
Yeah, of course. I'm not dumb. I don't need pesticides or diesel if I don't crop any apples. But what about my tractors?
Yeah, we will come to that issue right now. Overheads are, for example, depreciation of your tractor, interests of your bank loans, and other expenses like insurance, and of course, office workers. These are your fixed costs. You have to deal with them no matter whether you crop 1 million apples or just 5.
Ah, that sounds reasonable. According to my financial guy, I have $25,000 in overheads. So tell me, where is my break-even point?
Well, Farmer Joe, in general, when you want to get your break-even point, you have to take all your overheads and divide them by the contribution margin per unit. The contribution margin is the difference between your selling price and the variable cost.
Boring. Why don't you just tell me in numbers how many apples I do have to sell?
Oh, excuse me, sir. I will come to that right now. In your case, you've got $25,000 of overheads. And you divide them by your contribution margin of 50 cents. You get this contribution margin because you sell one apple for $1. And you have variable costs of 50 cents for one apple. And when you do all the fancy math, the break-even point equals 50,000 apples. And so, Farmer Joe, you have to sell 50,000 apples to reach your break-even point and to break even.
Whoa, wait a minute. Tell me, how on earth should I possibly sell 50,000 apples a year? What could we do to break even a little earlier? Let's say with 25,000 apples.
Interesting question, Mr. Joe. You see that 3 figures have an impact on the break-even point. And these figures are the selling price, your variable costs per unit, and your overheads. You could reach your break-even point earlier if you would raise, for example, your price, let's say by 20%. Then you make $1.20 per apple. So, let's see when you break even now.
So that means I break even at about 36,000 apples? Well, that's not enough. There's gotta be something we can do about this.
Well, let me think. Well, I'm sure you could work more efficiently and decrease your variable costs per apple to, let's say, about 40 cents per apple. Therefore, you would break even at 31,250 apples.
Well, that already looks way better to me, but I think there's still some room, isn't it?
Yeah, last but not least, we could try to decrease your fixed costs. Let us talk with the bank and insurances. Maybe we can fix a deal and decrease them to about $20,000? Then we could break even at 25,000 apples.
Well, that would be great. Thank you very much, fancy business guy.
My pleasure, Farmer Joe. It is not only my job to run around in fields and explain business terms to farmers like you. It is also my passion. You're welcome, my friends. You're very, very welcome.
Very corny to say the least, but it gives us the basis of what we're doing in chapter 5 about the break-even point and how it can help us manage our business more efficiently or get to goals of desired profit or production. So we'll talk about that this week as well. And you'll have a problem like that on your examination 1 this week. All right, that wraps up our introduction for today. We'll see you all bright and early Monday morning at 9:25. Have a great rest of the weekend, and look forward to seeing you this week as we head into our spring break week. Thanks a lot, everybody. See you then.